disaster loss is underestimated. In the global media, we often hear headlines like $1 trillion lost over the last 10 years. But if you actually look at how these figures were put together, they refer, in some cases, to either just insured losses, and into, at least in all cases, just for losses from the major disasters. Now, why we say the worst is yet to come is that in any given part of the world, most of the disasters that could possibly happen haven't yet happened. A lot of disasters only happen on 100-year, 500-year, 1,000-year return periods. And in most places, we don't have more than 100 or 200 years of records. So there's a lot of disasters which could happen and will happen in the future that simply haven't happened. And finally, our exposure is increasing. More economic assets, more population in hazard-prone areas means more risk and bigger disasters. I think it's absolutely critical, and it's one of the points that this report really focuses on. If you look at employment statistics around the world, more people actually work in what are called small and medium scale enterprises, particularly in the higher income countries and informal sector businesses in the smaller countries. These businesses are, amongst other things, heavily dependent on public infrastructure. We did a survey of 1,200 businesses in 6 disaster-prone cities in the Americas. And the 3 biggest impacts for these 1,200 businesses documented were due to power outages, in other words, the electricity going, water shortages, telecommunications going out. These were things which were interrupting their business, often forcing the business to fold and employment to be lost. Now, our statistics, and we've done surveys in around 56 countries, show that over 97% of these impacts on local infrastructure are due to smaller scale disasters. Yeah? So the smaller scale disasters are absolutely critical because they're affecting most of the areas of the countries most of the time. Well, I mean, really since the 1970s, we've seen, I wouldn't just say a wave of globalization, it's a new wave of globalization. Karl Marx was already talking about globalization in the 19th century, so it's not really new. But businesses, I mean, throughout the world have been offshoring, outsourcing, decentralizing their production to hazard-prone areas. A lot of these areas have got big comparative advantages for business. I mean, the one we probably read about most in the press is low labor costs. So businesses will decentralize part of their production chain to China or to Thailand or to wherever because they enjoy, lower labor costs, maybe, subsidized infrastructure from the government, better access to export markets. But while they've been doing that, which has obviously helped productivity, profitability, it's really made the global economy spin for the last 30 years. A lot of them have done this unaware of the risks in the areas where they were moving into. And I think the Thailand floods was a very classic case of this, where we had thousands of factories on industrial estates in a highly flood-prone area. Now, until those floods actually happened, people probably didn't think that those factories were toxic assets. They probably thought they were productive assets. But in fact, because they were in this high-risk area, they were kind of contingent liabilities. That's something which is going to turn into a liability when a disaster happens. And that's just one example. So if you think around the world, how many companies are sitting on huge amounts of assets in areas where that disaster hasn't yet happened? That's as much of a toxic asset as the sort of financial toxic assets we read about in the press. Tourism, I mean, is one of the growing sectors in the world economy. It's despite the recession, actually, despite the global crisis, it's one of the sectors that's been most resilient. And there's certain groups of countries that heavily depend on tourism. I mean, the economies of a lot of the small island developing states, whether it's in the Caribbean, in the Pacific, in the Indian Ocean, typically depend on tourism income for the value of 40, 60, 80% or more of their exports. So what this means is that, you know, a disaster in the tourism industry is not just a disaster for the hotels and for the people who own the hotels and the resorts. It becomes a disaster for the economy as a whole, because it then affects government revenue, it affects employment, it affects everyone. Now, most of these investments are being made, I think, without really necessarily looking at these wider impacts. So on the one hand, it's a threat. It's a threat to the tourism industry itself, and it's a threat to the islands and to the economies that receive the investments. But from another perspective, we can also look at it as an opportunity. If tourism is perhaps one of the few sectors in which these countries can be competitive to attract investment, it means that actually investing to reduce the risk is probably going to be one of the most effective ways of increasing that competitiveness. So we look at it, you know, as I said, on the negative side, a very, very high risk venture. But on the positive side, it's one of the areas where investments in disaster risk reduction can probably get most traction and produce most benefits, both for the business itself as well as for the countries. The studies we've done in this report tend to show that in general, there's still fairly weak incentives for actually getting disaster risk factored into urban development. On the one hand, I mean, speculating with real estate, with urban land and with housing is one of the quickest ways to make a fast buck. So if you're thinking about, you know, making a lot of money in a very short space of time, there's little incentive to worry about the 1 in 50-year earthquake or the 1 in 100-year cyclone, because by the time that comes, I've got a fairly high probability of having made my money and gone. And usually there's no legal clause, which then makes me liable if in 10 years' time that building falls down in an earthquake. By then anyway, my company may have folded and moved on, etc. So from that side, there's weak incentives. And from public regulation, again, it's, you know, I would say it's, even in high-income countries, it tends to be ineffective. There's too many loopholes. It's not easy to apply. And there's so many interests around it that it gets watered down. Even in the UK, which is a case we've highlighted in this report, there was new legislation, you know, basically trying to halt housing development in floodplains, in high flood risk areas, which was introduced in the late 2000s, I think in 2008. They can correct me if I've got the exact date wrong. But what the statistics tend to show is actually that the amount of housing built in those flood risk areas actually increased after the legislation prohibiting it was introduced. So if that's happening in countries which have got a relatively strong and efficient regulatory framework like the UK, you can imagine how easy it is to get round planning regulations, land use zoning and building codes in many other countries where the enforcement's a lot weaker, the capacity to implement those plans is a lot weaker. So the incentives, you know, on both sides are not very strong. One of the encouraging things, though, I think, as I said, because we're always trying to look at, you know, what the problem is, but also for signs, encouraging signs of change, is again, I mean, for example, if you look at the green building movement, which is now trying to build more energy efficient buildings or buildings that store their own water using green roofs and these kind of things. Environmentally, they're great. There's co-benefits in disaster risk reduction, for example, in reducing urban flooding. But perhaps the most important thing is they're proving to actually now provide more value for the developers. So actually, if I build a green building now, I can probably rent it at a higher rent, sell it at a higher price, and get more stable tenancies than if I'm just building a regular building. And in Japan, which is, you know, one of the countries that's really always been at the cutting edge of doing disaster risk management, they're finding the same thing with buildings that are, you know, guaranteed to be earthquake resistant, for example. They command higher rents, higher prices. So I think we're starting to see probably, you know, again, a change in the sort of underlying values, in which case the business will start saying, well, hold on, guys, rather than just making the quick buck and building something which will fall down. I can maybe make even more money, actually, if I build something which is more resilient. Agribusiness is again, it's a complicated one. You know, increasing prices means I want to produce more to sell more. So there's been almost, I would say, a rush into countries, but in different parts of the world, Latin America, Asia, but particularly in Africa, Ethiopia, Madagascar, Sudan, of buying literally millions of hectares of land to increase production and take advantage of rising prices. The risk here is that, I mean, a lot of this investment is going into areas where the hazard, drought for example, poorly understood, poorly modeled, poorly mapped. So it's very difficult, I think, for these companies to calculate the risks to themselves, but then beyond that in terms of the risks to food security.